Welcome back to the deep dive. I was looking through the stock auctions book today, specifically the chapters on administration, and I had this kind of realization.
Yeah.
We spend so much time in this world talking about the romance of equity.
The romance.
You know what I mean, right?
Yeah.
The golden handcuffs, the grant letter with all the zeros, this fantasy of the IPO pop where everybody goes out and buys a boat. It's exciting.
It's the lottery ticket.
It is.
Yeah.
But nobody, and I mean nobody, wants to talk about the morning after.
The equity hangover.
Exactly. The administrative headache. Because the moment that option vests, the fantasy kind of stops and the paperwork starts. Suddenly you have to actually find the money to buy the shares.
Right.
The company has to go beg the SEC for permission to issue them, and then boom, the IRS kicks down your door wanting their cut. Like, immediately.
That is a very vivid, if slightly terrifying way to describe equity administration. But you're spot on. This is where the rubber meets the road. It's not about granting the stock, it's the mechanics of execution.
And that is our mission for this deep dive. We're going full exam prep mode today. We're taking insights from the Stock Options book, 24th edition, and decoding that technical trifecta: financing, securities law, and tax compliance.
Chapters 7, 8, and 9 for anyone following along at home. And this is the real nuts and bolts stuff. If you're studying for a certification like the CEP, these are the chapters that, they really trip people up because they're so dense.
So we're going to simplify them.
Yeah.
And you should definitely stick around because we're ending with 3 specific knowledge check questions, real potential exam questions to test your retention. So let's get into it. Part 1, show me the money. Chapter 7.
Financing the purchase.
So let's set the scene. I'm an employee. I've got an option for, say, 1,000 shares at a $10 strike price. It's vested. The stock is now trading at 50, so I'm sitting on a $40,000 profit.
On paper, yeah.
Right. But to get it, I have to somehow come up with a check for $10,000 to cover the exercise.
And that's the thing. For a lot of employees, coming up with 10 grand or 100 grand in cash on a Tuesday is, well, it's not a simple ask. Liquidity is the first real barrier.
So companies came up with workarounds. The sources list a few, but the big one for public companies, it seems, is the broker-assisted cashless transaction.
It is the absolute standard. It's incredibly efficient. The best way to think of it is like a very, very short-term bridge loan that's provided by the market itself.
Okay, so how does that work in practice?
Well, it's all governed by Regulation T. The broker basically agrees to sell the shares for you on the open market, like immediately. They take the proceeds from that sale.
And pay everyone off.
Exactly. They use part of it to pay the exercise price to the company, another chunk to cover the tax withholding, and then whatever's left, the net cash, gets deposited right into your account.
So I never even have to touch my own savings. I just get the profit at the end?
Never. It's seamless. And here's a technical point. The timing of the settlement is absolutely critical.
Why is that?
Because, technically, for a very brief moment, the broker is lending you money. With the T+1 settlement cycle, there's a gap between the trade and the cash actually moving. Now, if the company were to float that money, it could be seen as an interest-free loan under Code Section 7872.
And the IRS is famously not a fan of free money.
Not at all. They'd say the interest you should have paid is actually taxable compensation. So having the broker as an independent third party is what keeps the whole thing clean.
Okay, so that's the broker method. What about when the company just handles it all internally? I saw that mentioned as net exercise.
Net exercise is a whole different animal. There's no broker, no open market sale. It's a transaction that's purely between you and the company.
So walk me through the math on that.
Mm-hmm.
Same example. I owe $10,000 for the shares.
Right. In a net exercise, the company just says, look, don't give us the cash. We'll just keep $10,000 worth of the stock you were supposed to get.
Oh.
So if the stock is at $50 a share, they hold back 200 shares to cover the costs, and they issue you the other 800.
That feels so much cleaner. No broker fees, no market risk while you wait for a trade. Why wouldn't everyone do that?
Liquidity. But this time, it's the company's liquidity. Think about the cash flow. When you do a cash exercise, the company gets a check for 10 grand. Cash in the bank.
But with a net exercise, they get nothing.
They get nothing. They forego that cash influx completely. For a cash-poor startup, that might be a non-starter. But for a big, mature company, they might actually prefer it because it means issuing fewer shares overall, which helps with dilution.
Right, keeps the share count down.
Okay.
Okay, I want to move to what feels like the most magical concept in Chapter 7, stock swaps or pyramiding. Just sounds like a scheme.
It's a fascinating bit of financial mechanics. A stock swap is really just using shares you already own to pay for the new shares.
So I'm paying with stock instead of cash.
Exactly. You exchange old shares that are equal in value to the exercise price. But pyramiding is the, let's say, aggressive version of that.
Okay, this is the part that always just blows my mind. Explain how you turn a few shares into a huge holding without any cash.
Okay, so imagine you only own, say, 10 shares of company stock, but you have options to buy 1,000.
Mm.
You use those 10 shares to exercise a tiny piece of your option. Let's say you get another 5 shares. Now you own 15.
Okay.
Then you use those 15 to exercise another bigger chunk, and you cycle through this process super rapidly, sometimes in a single transaction on paper, until you've exercised the whole grant.
You're using the profit from one cycle to fund the next one.
Yeah.
Building the pyramid.
Exactly. But, and this is so critical for anyone listening, especially if you're studying, there's a huge trap here. Put a big red star next to ISO stock swaps.
Incentive stock options. The tax-favored ones. What's the catch?
It all comes down to the statutory holding periods. You
Yeah.
know, to get the tax break, you have to hold the stock for 2 years from grant and 1 year from exercise.
That's the golden rule, right?
Well, if you use old ISO shares to pay the exercise price of a new ISO, the tax rules get really messy. The basis carries over, which is fine, but the holding period does not.
Wait. So I can't tack the time I held the old shares onto the new ones?
No, you can't. The text is very clear on this in Section 7.3.4. When you exercise an ISO with stock, the new shares you get begin a fresh, brand new statutory holding period. The clock starts at 0.
Wow. That is a nasty little detail. New shares, fresh clock, so you could accidentally disqualify your own ISOs.
You could pyramid your way right into a higher tax bracket.
Exactly. And one last point on financing.
Mhm.
We have to talk about why companies don't just lend executives the money. Here's $1 million, buy the stock, pay us back later.
Sounds very 1990s.
It was very common. And then 2002 happened.
Enron, WorldCom.
And Sarbanes-Oxley, or SOX, specifically Section 402, it was a sledgehammer. It flat out prohibited public companies from extending personal loans to their executive officers and directors.
No exceptions.
Pretty much none. It was a hard stop. It killed company-sponsored loans for the C-suite overnight, and it actually made everyone nervous about that cashless exercise we just talked about.
Because if the company arranges for the broker to lend the money, is that a violation? Is the company facilitating a loan? The SEC has never given a definitive no. The industry basically assumes it's fine if the broker acts independently, but still a bit of a gray area.
Okay, so financing is a minefield. Let's move to the second pillar. The regulatory web, Chapter 8. Securities law.
Right. And the basic rule of securities law is pretty simple. You can't just print up stock and hand it out like flyers. You either have to register it with the SEC or you have to find a valid exemption.
For public companies, that seems pretty straightforward. They just use Form S-8, right?
Correct. Form S-8 is a simplified registration just for employee benefit plans. It's way less painful than a full IPO S-1. The real drama is always with private companies.
The pre-IPO world.
Exactly. They can't use an S-8. They have to rely on exemptions. And the king of all exemptions here is Rule 701.
Rule 701.
Right.
So this lets them issue equity without the massive cost of a public filing. But I remember there's some math involved.
There is always math. To use Rule 701, the value of securities you sell in any 12-month period can't be more than the greatest of 3 different calculations. First, a simple $1 million.
Okay, bucket one.
Second, 15% of the company's total assets. Or third, 15% of the outstanding securities of that class.
So you do the math, pick the biggest number, and
Right.
that's your limit. But there's a second threshold, a dollar amount, that triggers extra homework.
Yes, and this is a critical update. If your aggregate sales in a 12-month period go over $10 million, the exemption is still good, but you now have to provide enhanced disclosures to your investors.
And by enhanced disclosures, you mean?
We mean financials. You have to open the kimono.
Yeah.
Balance sheets, risk factors. It's almost like a mini prospectus. And for a private company, crossing that $10 million line is a big, big deal.
Got it. 10 million is the magic number. Now let's talk about getting out. Rule 144.
Rule 144 is the safe harbor for selling restricted stock. If you get stock pre-IPO, it's got this restricted label on it. You can't just dump it on the open market the day after the IPO.
It's illiquid.
Right. Rule 144 is the path to liquidity. It basically says if you hold it for a certain period, usually 6 months for a public company, and you follow the volume limits, you're clear to sell.
It takes the handcuffs off. But the cuffs stay on real tight for one specific group, the insiders.
Section 16 of the Exchange Act. This is all about officers, directors, and anyone who owns more than 10% of the company. The SEC watches them like a hawk.
And specifically about short swing profits. I love this rule just because of how punitive it is.
It's the clawback rule, Section 16B. It says insiders cannot profit from short-term trading. If you, as an insider, buy and sell or sell and buy within any 6-month period and you make a profit, you don't get to keep it.
Even if it was totally accidental, you just needed cash for a new roof.
Intent is completely irrelevant. It is a strict liability rule. If the math works out to a profit from opposite trades within 6 months, the company is legally obligated to recover that profit from you.
And everyone finds out about these trades almost instantly.
Form 4. If you're an insider and you make a trade, you have 2 business days to file a Form 4. It is a very short window. If you're late, you get publicly named and shamed in the proxy statement.
Speaking of the proxy, that's where we get the CD&A.
The compensation discussion and analysis. It's the company's story about why they pay their execs what they do. And more recently, you have the pay ratio disclosure in there.
Oh, right, the one that always makes headlines. CEO earns 400 times the average worker.
That's the one. It's basically a public shaming tool dressed up as a disclosure requirement.
Okay, we've bought the stock. We've cleared the SEC. Now, the inevitable. Pillar 3, the tax compliance minefield. Chapter 9.
Death and taxes.
Let's start with withholding. I exercise my NSO. I make a profit. How much does my company take right then and there?
For non-qualified stock options, NSOs, that spread the profit, is taxed as ordinary income, specifically as supplemental wages.
Supplemental wages, so it's not taxed like my regular salary.
The withholding rates are different. For federal purposes, if your supplemental income for the year is under $1 million, it's a flat 22% withholding.
And if I have a really, really good day?
If you cross that $1 million mark in supplemental wages, the rate on everything above it jumps to 37%. And that catches a lot of people by surprise. They're expecting 22%, and suddenly nearly half their game is gone.
Ouch. Now, what about for incentive stock options, ISOs?
The ISO anomaly. For employees, there is no tax withholding on the exercise of an ISO, 0.
That sounds great.
It sounds great, but it's a trap. Because while there's no withholding, that spread is an adjustment item for the alternative minimum tax, the AMT. So you pay nothing at exercise, you feel rich, and then come April 15th, you might get a massive AMT bill you have no cash for.
The dreaded phantom income problem. Okay, let's talk paperwork. Forms.
NSO income goes on your W-2. That's pretty simple.
Yeah.
The real confusion starts with the brokerage reporting. Brokers send out a Form 1099-B when you sell shares.
I have heard horror stories about the 1099-B. What's the problem?
The problem is basis. Your cost basis isn't just the exercise price. It also includes the income you already recognized and paid tax on. But very often the broker's form doesn't show that.
So the form shows a basis of 0, or just the strike price.
Exactly. It ignores the taxes you already paid. If you just copy the numbers from your 1099-B onto your tax return, you will pay tax on the same income twice.
Wow. Double taxation by a clerical error. That's terrifying.
It is. Listeners, always check your basis. And then companies have their own reporting. Section 6039 requires them to file Form 3921 for ISO exercises and Form 3922 for ESPP transfers. The penalties for missing those are steep.
Okay, I have to ask about the one thing in the tax code that seems to keep every equity pro up at night. The big bad wolf.
Section 409A.
Break it down. Why is this little code section so feared?
409A is all about deferred compensation. And in the world of stock options, it creates one golden rule. You cannot grant an option with an exercise price that is below the fair market value of the stock.
No discounted options. The strike price has to equal the stock price on grant day.
Exactly. If you grant a discounted option, 409A says that's deferred compensation. And because it doesn't follow all the other strict rules for deferred comp, it fails immediately.
And the penalty is a fine for the company.
I wish. The penalty is on the employee.
The employee. But they didn't set the price.
It doesn't matter. The employee faces immediate taxation when the option vests, even if they haven't exercised, plus interest, plus a 20% penalty tax.
A 20% penalty on top of everything else.
Yes. It is absolutely ruinous, and that is why we say valuation is everything. You do not mess with the fair market value. Getting that valuation wrong can destroy your employees' financial lives.
One last tax point. Section 162 meters.
The $1 million cap. Public companies generally can't take a tax deduction for compensation over $1 million paid to their top covered employees.
But I thought stock options as performance-based pay were exempt from that.
They used to be. That was the huge loophole everyone drove a truck through. But the Tax Cuts and Jobs Act in 2017 got rid of that exemption. Now, for the most part, if it's over $1 million, the company gets no deduction.
The rules just keep changing. Okay, let's take a breath. That was a ton of information. We've hit financing, securities, and tax. Now, it is time for the knowledge check.
Let's do it.
I'm going to have our expert pose 3 questions based on everything we just covered. These are the kinds of detailed questions you might see on a certification exam. We'll give you a second to think, and then we'll give you the answer.
Okay, you ready? Question number 1. This one is on financing and ISOs. In a stock swap exercise involving incentive stock options, an employee uses shares they already own to pay the exercise price. If those old shares were also ISO shares, how is the holding period calculated for the new shares received?
Okay, think about that tacking rule we discussed. Do you get to carry over the time? All right, what's the verdict?
The answer is, the new shares begin a fresh statutory holding period. That's 2 years from grant, 1 year from exercise. You absolutely cannot tack the holding period of the old shares onto the new ones for ISO purposes.
Very tricky. You keep the basis, but you lose the time. Okay, question number 2. This is on securities law. Under Rule 701, for private companies, at what dollar threshold of aggregate sales in a 12-month period is the issuer required to provide enhanced disclosure, including financial statements, to its investors?
Remember, we said this number changed a few years back.
The answer is
$10 million. It was raised from $5 million back in 2018. If you sell more than $10 million in equity in a year, you have to show them the books.
Got it. Okay, question number 3. This is about compliance and 409A. If a non-qualified stock option is accidentally granted with an exercise price that's lower than the fair market value on the grant date, what specific penalty tax is imposed on the employee under Code Section 409A on top of their regular income taxes?
The penalty from the big bad wolf.
And the answer is
A 20% penalty tax, plus interest.
20%. That is a number you do not forget.
You really don't.
All right, let's wrap this up. We've unpacked the 3 pillars of administration: funding the buy, following the SEC, and reporting to the IRS. It's a lot less sexy than the IPO party, but it is what keeps the lights on.
It just highlights that granting the option is the easy part. The actual mechanics of execution, Chapter 7, 8, and 9, that's where the real work begins.
Before we sign off, leave us with one final thought, something for us to chew on.
Well, we talked about Sarbanes-Oxley's Section 402, how it bans loans to executives. And we talked about how broker-assisted cashless exercises are the standard. The fascinating thing is that the SEC has never, ever issued a definitive ruling on whether a cashless exercise is technically an arrangement of a loan by the company.
Really? After all these years?
The entire industry just proceeds, assuming it's fine, relying on the broker, acting independently. But legally, it is still a regulatory gray area. It all relies on that broker keeping the company at a true arm's length. If a company gets too involved in that process, they could be walking right into a SOX violation and not even know it.
A little gray area to ponder. Well, thanks for listening to this deep dive. Keep your strike prices fair and your forms filed on time.
See you next time.